Hey guys, Richard Matthews here with Matthews Wealth Management. We're doing a market update for what we've been going through here. So this is as of Friday, March 27th. The data that we're going to be going over is very number intensive, so this is not for everybody out there. A lot of clients of mine are very involved in understanding the data and wanting to be updated on what all is going on. So let's get started. First, what I have is a column for the first half of our quarter. So from the 1st of January until Valentine's Day, things were looking pretty good. So I want to go through that and kind of illustrate different asset classes and how they were performing. The overall indices, S&P 500 was up, NASDAQ was doing great, Dow Jones kind of a little behind, but everything was doing well. Bonds were all up. We started to see a little inflection point in the international stocks as well as emerging markets. Oil was, we had discussed this in our quarterly meetings, a lot of it was based on what's happening with Iran, Iraq, Saudi Arabia, Russia, and some international pressure. So that wasn't really anything to look at as far as what was to come. So moving on, precious metals had done well, and we started to see an inflection point in the value side of our matrix of equity holdings. So in large cap growth, we were doing well, mid-cap growth we were doing well, and small-cap growth we were doing well. However, on the values, we saw some negatives and a flat. So that should have, in hindsight, been a little bit of an indication of what was going on, but we made some changes along the way with this data in consideration. Let's fast forward a little bit to what we saw towards the end of the month. So if you recall, we made a large change, about 14,000 trades that we placed on March 13th. And in the email that I sent out to everybody, what we did was we increased our cash positions, some high yield bonds, small cap growth, short-term bonds, small cap blend as well, and our treasury inflation protected securities. We decreased our international, our large cap value, mid cap value, as well as real estate. So with that being said, let's look at what the second half of the quarter held. The indices plummeted. Obviously, we saw a negative 24, 26, 22. We don't have the data. Morningstar, the data aggregation that I use, doesn't have the numbers for high yield for the 27th yet. But we still see that bonds are holding strong in the second half of the quarter. International, emerging markets, real estate, oil continues. We saw precious metals continue to make gains and actually increase in value. Then you see just the everything falling off the cliff there. The cool thing about this, and I know to people who have lost money it's not cool, but from my standpoint, this is perfect correlation of what we expect to see when we look at value, blend, as well as growth, and how much each of them have lost in relation to each other. So it's interesting to see that the theories that we put into practice every day actually do follow suit in the real world bear market. So for the entire quarter up to March 27th, here's the numbers of what we're showing. The S&P is down about 21, Dow Jones 25, NASDAQ 17.5. Looking strong on our bonds. Those changes we made on the short-term bonds, the tips, as well as our other areas, all seem to be right, which is great. It's nice to see when the theories are put into practice. But international and emerging markets are down 23, 24. Real estate is a bit surprising, but if you recall, we underweighted real estate. Oil has fallen off a cliff. Everybody's noticed the gas prices here, but precious metals, gold and silver are the place to be. Moving forward, there's some opportunities. Some of you were dollar cost averaging in, and we're still buying some of these holdings for different types of stocks and mining and precious metals, etc. So there are a lot of good deals out there that we're still taking advantage of. And then you can look at each of these asset classes in the U.S. equities market. Again, the correlations are almost flawless. The small caps obviously lose more than large caps. The growths obviously have an issue compared to value. But when we look at our total portfolio, the entire practice, our firm, we're down 13.08%. When you look at some of these numbers, that's great. We're right where we want to be. Our job is to lose less than and make more than. So we're doing what we're supposed to do. Best account is actually up on the year. That's amazing, 1.01%. Worst one, we're down 18.4. By comparison, I'm perfectly happy with that. That's a fairly aggressive account. So we're doing what we're supposed to do. I know this is a tough time, but wanted to give you an update. All right, so we're going to take a look right now at the first quarter 2020 asset class performance. What we've got is the three metrics that we reviewed earlier from January 1st to March 27th, and we've got it broken down for the first half of the quarter as well as the second half of the quarter. So if you notice, first thing I'm going to look at is this orange circle, which is beginning of the year to Valentine's Day, and just go around the circle at the different asset classes and we can see the individual performance. So first things first, we have the moderate portfolio, which has generated a 1.8%. That's just a Dow Jones moderate benchmark that we occasionally use on snapshot portfolios. But going over to the S&P 500, we see it was up 4.87. Dow Jones was a little lagging at the 1.83 and so forth. But overarchingly, you see that the orange circle is pretty much positive. You got a couple of dips there with the commodity crude oil, and that one was down 14. We talked a little bit about Iran and Iraq, but it's the second quarter that really starts standing out, which is the gray, not even a circle anymore, but we can see the closer to the center, the bigger the losses. The further to the outside, the better the gains. So for example, if you notice the right side of the circle there, we're looking at Treasury inflation protected securities, corporate high yield securities, short-term bonds, intermediate term, and then you start to see the long-term bonds falling into the center. Another one that's done well is the gold in commodities down on the approximately 7 o'clock. Everything else had a major contraction. Biggest one, of course, is oil, but the overarching quarter is the blue outline, where we see pretty much the same thing on the bonds, the same thing on the gold, but it looks like from this graph that we made the right calls on March 13th. In hindsight, we probably could have waited another week. There was a lot of fundamental issues with margin calls that happened the following week from our trades that we placed, but there's no way to predict this stuff. I'm confident with the decisions we made, and they turned out to be the right ones. Now, going forward, depending on what we do as far as increasing our supply and production in our economy will dictate how our gambles as far as looking for rebound looks, but we had a very good parachute on the way down, and I think we're poised for a good bounce. So that's pretty much what I wanted to cover on this graph, and that kind of goes with the chart, the data that we covered on the video before. But hope this helps. This is a good visual that I use to see where the right bets are in terms of performance by asset class. Stay tuned for more videos to come.